Where to invest? Thank you. Restaurant shareholders must be rich. Looking for a profitable investment? Yes. Need professional consulting? Definitely. Maybe I should visit them.
Welcome, sir.
Thank you.
Please sit down. How can we help you?
Well, I'm interested in investing in restaurant business.
I think we have something for you.
The first company that we would like to present you is the Prezzo PLC. Prezzo is a chain of Italian restaurants in the UK. For 2013 it has 238 restaurants currently in operation. The first restaurant was opened in central London in the year 2000. So to understand the company's performance, we need to look at some key facts. So let's start with how the business is financed. As stated in the chairman's report, Prezzo's strategy of financing is retained earnings, which go primarily from the strong cash generation and short-term borrowings. And short-term borrowings are actually very important as the company tries not to get stuck in long-term borrowings. So the amount of short-term loans for Prezzo was around 30% of their financing, and another 60% of financing came from the retained earnings. So now let's turn our attention to some key facts. First of all, we need to look at the profit. So we can see the profit has been steadily increasing from 2009 till 2013. It was around 13 million pounds in 2009. Right now it's over 20 million pounds. This is obviously a very positive sign. The share performance. As we see, the share price was going up from 2009 to 2013. Actually, it almost doubled in price, which is one more positive thing. Quick ratio for Prezzo is not really good. As we can see in 2009 it was fairly high, around 0.7, but it has been steadily decreasing, and in 2011 the company was barely able to repay its short-term borrowings with short-term assets. It's been growing a little bit in recent years, but it still remains pretty low, so we can make a conclusion from here that Prezzo probably has too many short-term loans. Let's now review the corporate governance and sustainability report. The company, as stated in 2013 annual report, is following the policy of non-discrimination and equal opportunities. Disabled people are given all the consideration for the job, as are all other people. All the employees are provided with a training and with the necessary consultation. But the company doesn't say a single word about the environment and environmental protection, nothing about carbon emissions, recycling, which means that Prezzo is probably not paying much attention to the environment, and it's a highly negative sign. So let's now make a conclusion. Is Prezzo a company worth investing into? My opinion is it is worth investing into.
So the second company we would like to introduce is Domino's Pizza. It was established in 1960 in the United States originally, but then in 1985 it moved to the United Kingdom, and it was a complete success there. In order to find out why it was a complete success and will it be a success in the future, we need to look at the company's financials.
As we can see, the company shows stable growth. Revenues have been growing by 17% per year, earnings and dividends have grown by 30% over the past 10 years, and debt has been efficiently reduced. Not shown on the graph, the revenue in 2013 reduced along with the other factors. But it wasn't a major crisis for the company, and in 2014 they were able to grow their revenue. In order to measure the company's short-term liquidity, it is important to look at the quick ratio. The higher the quick ratio is, the better the company is managing to grow sales. Although the ratio fell in 2011 due to the crisis and in 2013 due to difficulties with the currency exchange, Domino's Pizza Group has shown a high quick ratio over the past 5 years, with a number constantly around 1. Domino's Pizza has 4 main sources of funding. 46% are the long-term liabilities, 26% are the short-term liabilities, 12% are the shareholders' equity and reserves, 16% are the retained earnings. Non-current liabilities reduced from 59 million to 44 million due to the movement of the 13 million facility from non-current to current liabilities. Therefore, the current liabilities increased in value. The shareholders' equity consists mostly of the share premium, currency translation reserves, capital reserves, and capital redemption reserves. The group has experienced a crisis in the beginning of the year because of the unstable exchange rate and 640,000 loss in Switzerland. The group has been able to increase sales by 5.6% in the other countries of the group.
In the CSR, Domino's has four main areas on which it focuses. First is the great quality of food and the nutrition of it. Second is the community. It works on educating the community and raises charity funds. Third is the carbon footprint. They calculate their carbon footprint and reduce emissions. And fourth is Domino's is a great place to work. In conclusion, it is possible to say that Domino's is worth investing in because it has shown stable growth year after year and is low risk, unlike some of its rivals.
The company I would like to introduce you is J.D. Witherspoon. It's the pub chain set up in London in 1976 by its chairperson, Tim Martin. For now, the company runs and operates more than 900 pubs all over the United Kingdom. The company owns in particular niche in the market, being one of the most recognized and fastest growing company. The company emphasizes on differentiation and innovation. It targets different markets by owning and running different kinds of pubs. In order to understand how the company is going, we should look at some financial ratios and some keys. The business is mainly financed by the shareholders' equity and liabilities. As we can see on the graph, shareholder liabilities, current liabilities, non-current liabilities, and also by getting receivables and generating cash-to-cash equivalents. As we see, the company generates high profits each year, while the liabilities of the company are greater than its total equity. The high level of borrowings and financial leases are resulted from the investment to new pubs, to existing pubs, repurchasing of shares, acquisition of freehold reservation and investment properties, repayments and dividend payments. Let's talk about liquidity ratios. Current ratio represents the relation between current assets and current liabilities. The higher the ratio, the more liquid the firm is. When liabilities are growing faster than assets, a company tends to face financial problems. Last year, J.D. Witherspoon's liabilities went up, meaning that the firm is becoming more liquid. The quick ratio determines the company liability to settle its bills by using quick assets. The J.D. Witherspoon's quick ratio significantly went up in the last quarter, meaning that the financial situation of a company is sustainable. The following ratio represents the performance of a company by comparing the market share prices with earnings per share. The increased ratio places the firm in a better financial position. The price per earnings ratio of J.D. Witherspoon increased in 2013, while slightly decreased in 2014, along with the earnings per share. How we see on the graph, the certain ratio remains average and stable among the competitors. In terms of social responsibility in community, the company invests in the local area. Furthermore, it runs the world's biggest real ale festival. J.D. Witherspoon is also involved in the field of charity, supporting young cancer patients. J.D. Witherspoon promotes recycling and energy consumption. It has the aim to upgrade and develop new pubs in order to minimize ongoing energy consumption. The company is definitely worth investing because it's stable, it's mature, and it has a constant growth for the last 5 years.
The last company that we would like to introduce is the Marston's PLC. It's a chain of pub that was operating for almost 180 years. It was originally established as the pub and brewer, but now it developed to almost 2,000 pubs around England and Wales and 5 major brewers. If we will look at the financial resources of the company, we could see that it mostly relies on the long-term debts, not the short ones, and the shareholders' equities and the cash were increasing but not very fast.
To know how well a company can deal with its short-term liabilities, we should take a look at the quick ratio. So we can say that during the 2009, the quick ratio of Marston's were at the highest point, and after that year, they were just jumping back and forth. But we can say that the Marston is actually more liquid at Witherspoon because of the difference of the level of quick ratio. Earnings per share could be very useful for the potential investor because they can actually show how profitable each issued share is and whether the company will be able to pay the dividends to the shareholders. So we can see from the chart that at 2010, the earnings per share of the Marston became negative. And this could be a result of the decrease in sales of the company. After that year, the numbers recovered, but then they just kept on decreasing. And we can say that for the potential investor, those numbers are not very promising. The returns on capital employed shows how much profit the company is making from the capital that was invested in it. And from the chart we can see that the numbers were increasing from the 2009, but then at 2012 they just dropped very fast, but then they recovered the next year. And we can conclude that the company was making loss during 2012.
In the corporate social responsibility field, Marston is very successful. It was constantly reducing the amount of alcohol in some of its beers, and at the same time the company controls its carbon emission and footprints.
So to conclude, I would say that Marston's PLC is not going to be a profitable investment in the future.
So, how can we conclude our project? Of course, it's up to a person where to invest to. Different investors seeking for different benefits.
From our studies, we can say that from two presented pubs, GD Witherspoon would be a better investment, and from two restaurants that were presented, Domino's Pizza would be a better option for investor as well.
Thank you for your attention.
Bye.
Okay, now I know where to invest. Thank you.
Yeah, welcome, sir. Have a great day.
You too.